Next, we have a panel discussion on a subject that should concern all, retirement planning. Our panelists will explore the opportunity for the Indian mutual fund industry to tap the retirement market in India and discuss the constraints that prevent the launch of such products.
May I request Dhaval Kapadia, Director, Investment Advisory at Morningstar India, to please come on stage and moderate the session.
At the back, or maybe I'll just need to adjust the mic a bit. Conducting sessions in the afternoon is quite a bit of a challenge. You need to make sure, that your discussion is interesting enough, to keep the audience awake. So, hopefully we should be able to do that today. I'd like to invite my panelists on stage. First up is Mr. Andrew Lill, who's the Chief Investment Officer, Asia Pacific for Morningstar. Next up, we have Harsha Viji, who's the CEO of Sundaram Mutual Fund. Then we have Karan Datta, who's the Chief Business Officer, Axis AMC. And an ex-colleague as well of mine. So, and finally, we have Rajesh Krishnamoorthy, who's the MD of iFast Financials India Private Limited. Yeah. Welcome. Since morning, we've been having a number of discussions surrounding views on markets and views on the macroeconomy and so on and so forth. I think on this panel, what we'll try and do is focus more on investment vehicles, particularly when it comes to retirement solutions. So, that's the topic of discussion today is mutual funds, a retirement, solution vehicle as such. In India, what we've seen, traditionally, the products that people look at when it comes to retirement are essentially, provident fund or gratuity or insurance or, possibly even fixed deposits. More recently, you've obviously had the, National Pension Scheme, which is the NPS that's come up. What's been, in a way, missing from the scene have been, mutual funds or direct products from mutual funds as such. We've had possibly about 2 or 3 products over the last, 15, 20 years that focus only on retirement solutions. So when I say retirement solutions is similar to things like target date funds and so on, which we'll discuss, going ahead. So those kind of products have been missing from the Indian market. And just to add a perspective, in the US, retirement assets that are invested through mutual funds contribute about $6.8 trillion of assets as such. And they comprise about 43% of the total mutual fund market in the US as such. So, clearly, there is a huge opportunity or headroom in terms of growth when it comes to, mutual funds in the retirement space in India as such. And so our discussion is sort of going to surround, how do mutual funds plan to tap this market in India? And what are the possible constraints, around this? My first question in that context goes out to Karan. Like I mentioned, we've seen only about 2 or 3 products in the retirement space, in India, in the mutual fund industry, which are directly addressing, retirement as such. And this is despite the fact that, there are various tax benefits available, so it is sort of being covered under the ATC umbrella or the umbrella under which you can get tax benefits as well, like ELSS. So, what's your sense? I mean, why hasn't the industry really focused on this space?
Focused or fought hard, whichever word you want to use. Good afternoon, everyone. Thank you for having me here. Actually, what I'm going to do is just step back a little bit and not speak of what is already there, but just kind of shift the perspective out here a little bit. I just think it all boils down to the language that mutual funds have used or not used while communicating the benefits to the end investor. And the reason why I say that is today in India, you've got track records of almost 20 years showing some serious returns and performance that the end investor has just not experienced. In the morning, I think, Andrew, you spoke about, or I think Haywood spoke about the investor returns versus the product returns. The point I'm just trying to make is simply because we've not had the language barrier crossed, we've not been able to showcase 20-year track records to our investors. Hence, existing funds, asset allocation funds, existing open-end funds could have been brilliant retirement solutions by themselves. You don't need to necessarily relook or redesign everything or wait for regulatory approvals for tax incentives to come in and kind of relaunch retirement solutions. That's the first point. Second, yes, there has been a lot of effort that the industry has tried to do in going back to the regulator asking for tax breaks, because that's the real genesis in the US as well. Those things seem to be starting to come in place now. My own guess is over the next 2 to 3 years, a lot of those products would start to come into place, and the start of which we saw as a budget highlight under the mutual fund retirement linked plans. Having said all of this, I just feel as an industry and as a mutual fund company with 20-year track records, there is a lot that we can do even with existing funds. There is no reason why an FD should become a retirement solution and not a 20-year-old track record fund.
Okay, okay. That's a fair point that, that can you really look at, I would understand when you say, a 20-year track record, you're possibly meaning, pure equity funds.
No,
so,
balanced
okay.
funds. There are balanced funds now with 15-year track records. So it's not necessarily equity funds by themselves. And sorry, I'll just take an extra minute out here. To demonstrate trust and credibility, and certainly in the retirement space, we've got now the actual track record to demonstrate the next 20 years. I think that's the point I'm trying to make, and that's not necessarily equities. It's a lot of balanced funds, asset allocation funds as well.
Sure, sure. The way we see it and the way you've seen products evolve in sort of other markets is that, and typically the way one would approach, a retirement product would be that maybe if I've got about 25, 30 years to retirement, I start with a larger, sort of allocation to equity, and gradually over a period of time, I move it down. So, when we say, and that's how target date funds are structured. So if you've got, a target date fund, which is, for example, a 2030, maturity, it will start with a higher allocation to equity and have a glide path by which it will reduce the equity allocation as you approach retirement. So possibly, I mean, we haven't seen, although like you mentioned, maybe we've got products like balanced funds which do, asset allocation, but the asset allocation will be relatively static, isn't it? So we haven't seen funds which can change the asset allocation, based on an investor's time horizon. We haven't seen too many of those funds in the Indian market. Yeah, Harsha. Yeah.
Because that's not the issue, right? Can you hear me in the back? Is it working? Huh?
Yeah, it's working.
Okay, so that's not the issue, because an investor right now can rebalance their portfolio anytime through a mix of debt and equity. I'd like to build on what was said before. I don't think retirement products is the issue today. It's great to see so many of our friends from the IFA community here. I think to say that if you're going to sell a retirement product today, it's pretty much impossible. And I'll tell you, it's a psychology issue, what you're talking about, experience of returns. The way investors behave is conditioned by what they have seen. You can put how many ever charts you want on what SIP returns are, 20-year returns are. I have them in my PowerPoint. You have them in your PowerPoint. Fact is, you take a 32-year-old guy today, professional, coming up. In 2007, he got his first real job after his MBA and gave his first paycheck to his mother. He's never seen a non-volatile market in his life. Right? Those are the clients, those are the investors we want. He's never seen a non-volatile market in his life. Right? And if you look at how investors behave, we've done extensive market research also. And how investors behave is not how they say they behave. Investors say they're coming in for a 3-year, 5-year horizon. The average Indian investor leaves in a year and a half to 2 years. Now, regardless of fund management capability, that's a lottery, whether you make money or not. And the problem is that if half our investors lose money, they're going away with a bad experience of our advice, of our funds, and of the industry in general. We have a fundamental lack of trust and credibility, right? So if someone is saying, look, when I say pension, he's saying, will I bank my old age and my life on this asset class, right? We are not remotely there yet. Whatever chart you show, if you say 20 years from now, I will put my faith that this equity, debt, mix, market traded NAV will look after me in my retirement. We have a long way to go. And I would argue actually that the first step is, as you said, to show credibility. But also, interestingly enough, if I can just take a minute, close-ended funds play a very important role in this. And I'll tell you why. I think there's been a lot of press lately saying how close-ended funds are bad, distributor commissions are high, mis-selling happens. I think that's rubbish. Because basically the point is this, right? If you stay invested in the market longer, you'll come away happier. Statistically, on average, law of gravity, anywhere in the world, this is true. And if we have investors who are checking daily NAV, get nervous and leave after a year and a half, they're going to blame us. So the only way to create happy customers is to lock them in, right? Now, we have been saying for years that the way to do this is SIP. SIP is also sort of a pension type product. The way I keep telling my guys is, look, close-ended fund versus an SIP is like an injection versus a pill, right? You want to be well for your retirement. The right thing to do is to take a pill every day. But you know the guy will stop taking his pill. Injection pains more when you give it, but it will make sure that the experience comes. So I think we need to build up. We have to build up the credibility before we even talk about retirement products. Because I think the IFAs community, I talk to distributors, I think we're very far from that now.
Okay. Fair enough. I think the points that we're trying to make are that investor education is critical. Understanding an investor psychology is critical. And having said that, obviously the industry has been in place for a while. And I'd like to just get Rajesh into this discussion. Obviously, Rajesh works with a lot of IFAs, so I'm sure he'll give us a perspective. Have investors changed their attitude towards looking at retirement solutions? Do you see a change in that? Are they still sort of focused more on low risk, low return products like a typical insurance or a typical provident fund? I mean, how do you see it on the ground?
Dhaval, with your permission, I'm audible, right? Yeah. Can I just use a bit of physics in this conversation?
Please.
We're just after lunch. How many of you have watched the movie Interstellar? A few hands up there. So I just try to combine some of the spectacles that we see from Christopher Nolan. In the movie Interstellar, what he says is that if you want to go from point A to point B, you have two ways to do it. One is you just go across from point A to point B, or you have a concept of a wormhole wherein from point A to point B, you can just bend the space and just go through. Now, my experience of dealing with advisors has been that advisors always want clients to go from point A to point B, which is 20 years of his retirement journey. But the client mindset is such that he just wants to bend the space and finish it off in a year's and 2 years' time. Now the only way we could achieve it is if somebody here, whether it's Karan or Harsha, comes out with a wormhole of a product in pensions.
Okay.
Yeah. That was just one of it. But yeah, on a more serious note, I think tax incentives do work.
Okay.
And I think a lot of our pension-related investment orientation in India has been driven through some of the tax incentives.
Okay.
And that brings me to this question that I've been seeking an answer to. That in the union budget, there was a bullet point in the budget highlights that mutual fund linked retirement plans would be given the same tax treatment as other retirement products. But unfortunately, I haven't seen anything come out of it. So I guess there is a combination of the will of the industry to pursue this as a real potential opportunity, given that there was a reference, but nothing else has come up. So I think it's there as well. So as an intermediary and as an advisor, I would first ask this to the manufacturers as to when would you leverage on that bullet point. Okay. And as a consumer, I will still try and see how can I manage this behavioral gap, so to say.
Sure. So I think the three of you share a similar views. So we'll try and get Andrew into this discussion. How has been your experience of looking at the pension fund industry in Australia and in UK where you had worked earlier? So. How do mutual funds really position themselves within that space? If you could.
Yes, well, thank you. And there's been some very good points made about retirement investing. It's a topic that's dear to my heart. I spent most of my experience in this industry working to meet the goals and expectations of retirement investors, both in the UK and Australia. So all the things that have been said are absolutely true, right? So both Australia and UK moved from an insurance-based structure into a tax-advantaged mutual fund structure. What are the benefits of that move? Well, first and foremost, the benefit is that the individual feels more engaged, feels more able to control their investments, and therefore feels more engaged with what their investments are doing towards their eventual retirement. What are the disadvantages of that structure? That just as was just said, no individual wants to withstand the test of time, the 25 years of compound interest that it takes to achieve your objectives, and everybody tries to find a shortcut. The challenges that we have as an industry is to try to keep the individual engaged, give them a degree of control, give them a degree of transparency as to what they're investing in, but to help them or to stop them doing something stupid or wrong with their investments at the wrong time. Some examples: investing in a leveraged equity fund in 2007. It seemed obvious to the less or semi-educated investor that on the back of 20% returns for 5 years, the shortcut was to just extrapolate those 20% returns and use leverage as well, and you'll just get there quicker. It's obvious. However, for those people that were faced with 2 years of negative returns just at the time that they were about to retire, and therefore had the biggest retirement pot of their life, the money-weighted return as opposed to the time-weighted return was significantly damaged. So what did the industry do? It tried to regulate, and in some cases in Australia, it's given people more choice. Completely the wrong thing to do, because now they go out and buy two-bedroom apartments at already very highly inflated values. So I think the key for me is to try and find that happy medium between mutual funds that give transparency and open disclosure, use long-term investing techniques, use the communication of risks, so it's not being sold as a return maximizing vehicle, it's been sold as a way of minimizing risk, helping you to achieve your retirement goal earlier without giving too much control or too much ability to do the wrong thing to the investor.
All right. Andrew, just to take that point a bit forward, do you think, investors, the way you've seen them, are they able to manage the asset allocation on their own? For example, if you say that you get into, a product where equity is maybe an X% and debt is another X%, and it remains the same over a period of time, do you think, investors are obviously, as they approach retirement, they would need to, modify their allocation and, like you said, to try and reduce the risk in their investments as such. So, do you think investors do that?
I think they can do. I think that with good advisors, it's even more possible. I think the area where the industry has underestimated the ability that investors take risks at the wrong time is for the investors that are perhaps disengaged and just want a one-stop product, one product that will take them throughout life. And that's where I think the target date funds, the lifestyle strategies that have been very much the normal way of investing now for retirement funds in the US are really a great way of managing the risks through life, changing the asset allocation at the right time as your age or your particular kind of career or industry sort of changes. I think also as you approach retirement, as the horizon shortens, that's the area where I think investors traditionally are not good at asset allocation skills. They're not aware of the potential for losing money or capital drawdown in the next sort of 2 or 3 years. As I spoke about earlier, I think the opportunity in, if you don't take into account valuations, is that you can be investing in an asset class that seems to be the right thing from an economic growth perspective, but has the potential to be priced for perfection and then lose 20 or 30% in the next 2 or 3 years. So one is think about time horizons. Asset allocation over short time horizons is very hard. And for those that are prepared to give you control of their investments through life, thinking also about longevity risk for those that live longer than they expect, how do target date funds meet that particular need?
All right. So what you're saying is possibly is that investors do require some help when it comes to managing the asset allocation of their portfolio as they approach retirement in a way, and that's where possibly target date funds in other countries, particularly developed countries, have been fairly successful. In fact, in the US, target date and life cycle based funds manage about $1 trillion of assets. So clearly that there is some amount of investor demand for those kind of funds out there. That brings me back to Harsha, in a way that in India there was a vehicle that was created a few years back called as the National Pension Scheme, the NPS, which was in a way meant to allow investors to route their investments into multiple asset classes, right? So they have this option of investing in equity funds. Obviously, there's a cap at about 50%, on your investments in equity as such. But they have that flexibility, or they provide the flexibility to invest, across mutual funds. Clearly, we are seeing that hasn't been very successful. So, do you think this throws up an opportunity for mutual funds to step in with, products that cater directly to, to clients rather than going through, routes like the NPS?
Let me do a quick poll of the audience. How many of you have clients who are looking at an equity horizon of 15 to 20 years? Okay, so it's about maybe 5 to 10% of the population, right? I think that's the answer.
Okay. Yeah.
Sorry, if I can just make a point here. We've done some work around goals and plans for investors. I don't want to get into details about that, but just sharing some experiences on that. The number one goal in India, if you just talk to investors, is actually children's education. And that's quite logical, that's quite understandable. But the number two goal, the single biggest second goal is retirement. And this is for a country which has the advantage of age on its side. So it's child education on the first and retirement on the second. And you can imagine the liability that retirement will cause for a population which is going to age in about 25, 30 years from now. I think one of the things it all comes back to is perhaps we've not articulated the concern in the minds of the investor very seriously. And that is perhaps why you don't have too many hands that go up when it comes to 15-year investing. And that is where, again, the opportunity really lies, because as an industry, why should we be a 3- and 4-year holding period product in the first place? It just doesn't make sense. especially given the fact that we've demonstrated such brilliant track records over the last 20 years. So to my mind, I think there is a serious requirement for mutual funds to fill the space of retirement. And Rajesh, to your point, yes, asset management companies have started to file for the mutual fund linked retirement plan. In fact, we've also done that with SEBI. It's now for SEBI to take it to CBDT to get the tax break approvals in times to come.
Sure. Just to get Andrew back into the discussion, I think because a focus of the discussion has also been, taxation. So how important do you think it is when you're looking at a retirement product? How important is taxation, when you're creating a product as such?
Well, certainly in Australia, because the retirement vehicle or the retirement product is tax advantaged and is more advantageous than any other form of investing, then to be honest, retirement investing has become the only form of investing. I think when it comes to finding the right investment strategy, if you can invest in a low-cost strategy that is tax advantaged, then you are halfway towards meeting your goals. So, certainly taxation is an advantage. It can also be a threat because it just so happens that, using the Australian example, Australian equities receive additional tax advantage compared to global equities. So, of course, that means that many, particularly older investors, think that investing in 4 Australian bank companies that have advantageous tax dividends compared to the rest of the globe means that they have no reason to invest outside of 4 Australian bank companies. The benefits of diversification, the benefits of business cycle investing, knowing that the same companies and the same stock prices don't keep going up forever, is something that we have to think through as far as tax advantageous. The one point I'd like to make on the long-term objectives. It's very, very important that when you come to retirement investing, that the mutual fund product that is offered communicates success in a way that is long-term. It's both in the UK and Australia, some big problems have been caused, and they're still causing problems, by forming an industry that compares its success on a quarterly basis, dependent on how this mutual fund has performed relative to its competitors in that particular quarter. Now, it doesn't matter whether you're a value investor and therefore think that investing over the long time horizon is important, or just focusing on meeting a retirement need. What you really want from a retirement need is beating inflation over and over again by a small amount and avoiding big capital drawdowns that tend to get people disengaged and stop saving. If you keep producing real returns year by year, people keep being engaged and they keep saving. But the way you communicate those must be about how you are going on the path towards delivering an income in retirement that meets your expectations. Perhaps it meets your need to be able to look after grandchildren, to take your wife out for dinner once a week, to go on one holiday a year. That's what retirement investing is about. It's not about this quarter, this year, my mutual fund has outperformed its competition by 0.25%. It is irrelevant.
Sure. I think the message that's coming through most of the discussions that we are having now is that investor education is critical, right? So Karan and Harsha have in a way pointed out that the challenge is investor psychology towards investing in equity is relatively shorter term. So maybe 3 years, 5 years. Not too many people are looking at 15, 20, 25 years as a horizon. So clearly investor education is something that one needs to focus on. So that again brings me back to Rajesh. Do you think that the distribution as well as the mutual fund industry and the entire industry as a whole, is it doing enough to focus attention to investors about the importance of retirement planning? I'm sure a lot of investors do it, but the right way of doing it. So today most products, like we said earlier, are debt focused. As interest rates go down over the next 10, 15, 20, 25 years, the kind of kitty it can build will be limited. So do you think distributors and the community as a whole is doing enough in terms of investor education?
Well, yeah. Can I just take 2 steps back and connect a few dots to get to this point? My top view is that so far as the Indian asset management industry goes, today we sit in a juncture which is, I would say, the most critical of the phases of launching this industry into the retirement space. However hard we've tried earlier, as an industry, the fact remains that we've failed. Whether it is the manufacturers or the intermediaries, we have not been able to communicate the fact that asset management companies can provide a vehicle for you to actually proceed towards that goal of retirement. Which brings me back to Nolan. I'm sorry to use space again, but I guess it's a fact of life that the spaceship that we are traveling in is giving you this false feeling of gravity. And when I use gravity in the financial perspective, it is real returns. The spaceship that we are all traveling in earlier was the defined benefit plan. And in real return perspective, in the Indian context, last many decades, it would have hardly given us decent single-digit returns. Should be lower single-digit returns. I think where we have failed in investor education, specific to this, is that if the industry wants to promote sticky and long-term assets, and I mean India is a brilliant opportunity today because, not because of the change in government or policy and things like that, but if you see any fund that has been around for the last 20 years, 15 years, I mean you can see the numbers for yourself. 10 becoming 700, 70 times to your investor in 15 years is no joke. So whether it's the Franklins or the Reliances or whichever asset management company that you take, it is in front of us. There is proof of pudding, not just concept. There is proof in front of us that 15 years you stick to somebody and you're going to walk back with 70 times. I'm not saying that that's going to repeat in future, but you do have proof. You have evidence. So there is no absence of evidence today. That's number one. Second is that the regulator has told you that 2%, 2 basis point of your fees, please plow back into investor education, which means somewhere there is a force working from the background saying that put more money into your communication. But somewhere where I think we are getting it wrong is, I would say the vehicle is nothing but the marketing communication. The spaceship that we are traveling in, the marketing communication to the investor is giving this wrong feeling of gravity, which is nothing but centrifugal force forcing us and making us feel that there is gravity. But the real gravity is on earth and it is real returns. And you got to get the customer back to the ground and say that unless you have real returns, my dear friend, when you retire, you will not be able to afford a cutting chai. Because your money doesn't have purchasing power. That's reality. Now, this spaceship is the marketing communication. And I think a lot of the work has to happen on the marketing. And I think some of the fund houses like IDFC and Axis are doing a good job of trying to change the way we communicate. If we do that, we make simplistic spaceships to portray to the travelers. I think the intermediation will just run with it, and we'll be able to get a lot more investors to give sticky assets. That's my belief. Sure.
Yeah. So I think two key things, which Rajesh has obviously articulated very well, is that one is you have some evidence of a track record. So you have, like was even mentioned earlier by Karan. So you've got balanced funds, you've got other funds that have got a 15, 20-year track record. So you've got evidence. You need to create possibly, good communication around it. You need to create, from an investor, positioning perspective, you need to create a good, possibly a wrapper around it. Karan, any views on that? Or?
So this is now many forums, and I've said this many times. All we have to do is talk the investor's language. The investor's least bothered about large cap, mid cap, small cap, duration, income. Their life is all about dreams, goals, and plans. And I think that's the education first we need to imbibe in ourselves and then kind of relay it back to the customer. And what happens is when you anchor a thought in the investor's world, in the investor's goal, then the longevity takes care of itself, because what you're really doing is going back to the investor saying that I thought this was for your retirement, I thought this was for your child's education, and suddenly the entire paradigm changes. And I would go back to the morning discussion Hayward had, and he spoke about changing the investor behavior, and that to my mind is a little bit of education. Don't like to use the word education, but I think just starting to talk the language of the investor is perhaps the first and most critical step. And that in itself could change then dynamics out here.
Yeah, absolutely.
Just add one thing to that, if you don't mind.
Yeah, sure.
I actually differ a fair bit on this. I don't think the problem is investor education. I think everyone in this room has made the case to investors that long-term equity, you have the charts, you have the statistics, right? I don't think there's anyone in this room trying to sell equity as a 12-month product. And as you said, the case is compelling. You look at 15-year returns, the case is compelling. So the answer is not just more education. I think this is a case of, what they say, operation successful, patient dead. Basically, we are communicating this, but it's not getting through, right? And
I think the mode of communication is the real challenge.
no, I'm saying mode of communication, I'm not saying we shouldn't do. The opportunity in pensions long term is huge.
Sure.
There's no doubt about any of the things that have been said on the podium, but I think the difference between theory and practicals is what I want to get into, right? The theory is perfect. The practicals is no one wakes up in the morning in this country and says, I want to buy a mutual fund today. It's very much a push product, right? And we have to educate and push the mutual fund. Pension is a pull product. You cannot push pension on anyone. You must have the need, you must want it, right? As a push product, pension will never work. We can educate, we should move, but ultimately, going back to my injection analogy, actually my daughter is getting her vaccination in Chennai right now, so I'm very happy my wife is dealing with that. But the basic fact is that when you get an injection, you need a sweet with it. If you don't cry, there's no other way I can take her to the doctor, right? And that's the tax breaks. If you want to create pull, it has to be tax breaks. You can never sell NPS as a push product, right? So I think we also have to be practical in how we go about it.
Okay, okay. I think that's a fair point as well, that, you need to get theory down to reality as well. I mean, you can't just possibly live, in a theoretical space. And, that brings me, to another point. Clearly the success of mutual funds as a retirement vehicle in some of the other countries has been driven by the regulatory framework. So, like I said, the NPS equivalent vehicle, in the US is a 401k, so which is mandatory for employees to, put their money in, and that's how, mutual funds or money gets routed to, mutual funds as such, and the retirement kitty gets created that way. So just to give you a perspective, in terms of a regulatory role, 81% of mutual fund owning households in the US own mutual funds through the retirement plans that are sponsored by their employers. So, the equivalent of an NPS or the equivalent of a provident fund. So, I mean, do you think regulator plays a critical role in this, Andrew, if I were to put that out to you?
Yes, so it's very important that mandating is important. So it's important that every month you're making that contribution. The US has done a good job of providing the average person with a retirement income. Some mistakes were made at first in the 401k plan, where because of the legal system in the US for trustees deciding on the investment strategy, they felt unable to make an investment decision to invest retirees' assets in anything other than cash. And so the default strategy, if the individual made no choice on their form as to where to invest the 401k plan assets, was to go into cash. It's only through sort of looking into the particular kind of trustee law and giving kind of trustees and fiduciaries the ability sort of to have confidence that they're not going to be sued if they put their investors into equities or fixed income assets, that the default strategy has come through to be the life cycle or the the target date fund. So some quick wins were actually lost in the US through the default strategy and by having cash in there at the wrong time. So it's certainly very important that the wrapper is important, it's tax advantaged. It's important that the wrapper captures everybody and gives everyone through their employment an opportunity to invest. And then for those that don't feel able sort of to tick the box and decide for themselves where to invest or don't have the advice, then that default strategy has to be correct as well. And it has to be broadly a balanced strategy with a degree of dynamic asset allocation. Like right now, investing in US Treasuries with yields at all-time lows is not a low-risk strategy. So you cannot form rules that withstand 10, 15 years. You have to be aware of investing money at a certain time has different risks.
Sure, sure. Just as a final question to the product manufacturers per se, over the next 6 to 12 months, do you envisage launching any product specifically for the retirement space?
Absolutely. Like I said, we've already. I'm sure a lot of other AMCs have already applied for the mutual fund linked retirement plan. So have we. We'll wait for SEBI's approval and then CBDT approvals. Apart from that, on that entire point around target date funds, I think there has been a bit of effort that AMCs have made, so did we. But there has been a bit of pushback from the regulator. There was there were questions, etc. And we've not been able to get that going. But certainly the mutual fund linked retirement plan is something which is, over the next 6 months, I certainly envisage that shaping up
sure.
with the regulators.
Sure.
I'll stick with what my thought process is, which is there's no reason to put the cart before the horse. Right? Pension will happen, we will get into pension when it happens. But our strategy very clearly now is closed-ended funds, longer and longer tenor. And the reason we are doing that is very simple. We want guys to walk away with an NAV higher than they came in. I have no idea what's going to happen to the market. We can talk whatever we want about Modi, BJP, India Renaissance, but you know that 2 years from now we don't know where things are going to be. So to create happy customers who are willing to come to us for advice for the long term, we have to start small. So I think that's the immediate focus for us.
Sure. Do we have time for questions? Can we take a few questions from the floor? Yeah.
You mentioned you're a fee-only financial planner. I heard that, yes.
See, I have a lot of people, retired people coming to me saying that I want to invest, I want some regular income, monthly income. Okay, I can put in a FD, but FD returns are very low. Okay, there are not many options. But I don't see anything from mutual fund side actually helping retired people to invest their corpus. In Kerala, I am coming from Kerala, at least 40,000 government employees retire in a year. Okay, if you take India as a whole thing and see the kind of people, private sector including how many people retire in a year, it's a huge market which is unaddressed. So there the corpus comes in big amount, like tens of lakhs. And you can manage, but only thing is you have to be like giving a regular income, but better than the bank deposit. Can you do that?
Karan, you want to? Yeah.
So I think you make a very, very critical point. All of us have been discussing the accumulation phase, and I think the point you raised is about distribution, i.e. annuities. Now, if you look at the annuity space, even within the insurance business, they're struggling to kind of get through with the annuities because the rates are at about 4.5%. In the mutual fund world, I will give you the example of a very simple facility that we have but have not utilized very well, a systematic withdrawal plan. In our wisdom, we call it systematic withdrawal plan. But just think of a systematic withdrawal plan for a very simple balanced fund over the next 20 years. That is your annuity. Now, I think the point, again, I'm just trying to leave with is that we don't need to go back to the regulator. We've got many things going within the community itself. All we need to do is take it out in the right manner, fit it into a goal, and you'll have the transaction going.
Hello?
Sir, here.
I think you ran out of time.
Sorry, there's somebody there.
Can you hear me?
Yes.
So, yeah.
So, my name is Chandan Kishore. I am from Business Standard. So my question is to Mr. Harsha. So he mentioned that all those reports that about the close-ended products, that those are wrong and with the higher commissions to the distributors. He termed that as a rubbish, all those reports. But now, my simple question is that suppose had the same product came back in 2004 with a 5-year lock-in period, then what would have happened to the investors? And what the responses would have been of the advisors to the investors?
Can you repeat the question? I think possibly the question was around, if you had close-ended funds maybe 5 years back. If you can correct me if I'm wrong.
No. Okay, so I'll tell you why 3-year close-ended funds are like a lottery. Okay, if you just look at rolling market returns, forget everything else. Look at rolling market returns. On an 8-year rolling basis, in 20 years on the Nifty, there's never been a single case where NAV has been lower than where it was, and you've got consistently good returns. 3-year close-ended funds, 2-year close-ended funds, we also launched, right? 2-year, 3-year close-ended funds in a volatile market are a lottery. So when I'm saying close-ended funds, I'm talking about the close-ended funds which are hard to sell, which are 5, 8, 10-year, right? And that is good for the investor, right? No, we're not forcing any investor to buy that funds. Only the person who has the liquidity and horizon will come into it. But if you take a longer horizon close-ended fund, you will end up with investors who will thank you at the end of that. And you de-risk yourself very practically. You de-risk yourself from the fund house. You de-risk yourself from the fund manager, right? You might get positive active returns, negative active returns, but simply the market will give you enough rise in tide float to keep your customer happy.
Sure.
But
I think possibly one last question, because we are unfortunately running behind schedule a bit. Yes.
Sandeep from Axis Capital. I would like to ask one question to all of you that do Indian investors face what in physics language, what you can talk, the tendency of inertia, where they maintain status quo on their investments. In other words, their investment thought process, where they, in spite of several communication to them, in spite of educating them on retirement solutions, on how equities can give better returns to them. But what has been observed that they go ahead and put their savings in FDs, even though it is a span of 5 years, 8 years. My experience is that in spite of educating them, they put their investment in FDs or any such traditional investment asset classes. Is there a way out? And in fact, I had a number of meetings with corporates where I had discussions with the HR, how we can arrange a workshop for the employees of the organizations. But it is not successful at all. So can we go ahead and talk to the HR since many of you are in fact equity fund managers also, and you are in touch with these companies. So can we go ahead and talk to these corporates and communicate to them that yes, why don't we engage workshops? And
maybe I don't have a straightforward answer to your question, because that's what I guess everybody struggles with. But I can share with you one successful, one successful or a success story of a successful advisor that I have seen myself. He works on the Singapore platform at iFast. What he does is that when he gathers his investors and he has to speak about retirement, he actually stands in front of them and enacts as if he is speaking to an older himself. He stands in front of the crowd and he talks to the crowd as a young man, and then goes to the other side of the audience and talks as if he is the old man. And in that conversation, he brings in the concept of purchasing power. He brings in the concept of why bank investments are not a good option for retirement. And he also brings in the insight of the real returns, and that you are traveling in a world which is not really giving you the returns. So I guess these tax incentives, etc., at the end of the day only increase the real return in the hands of the investor. And therefore, the only success that I have seen on this retirement space, which is really done him very well, and he's an author of 2 books, and he shares these in his books, is this. Have a conversation in front of your potential investors with an older you. That's what he calls.
Absolutely.
I hope
I think the message clearly is simplifying your communication and you know, breaking down whatever you're talking of. So, you know, asset allocation and so on and so forth is obviously, you know, more technical in nature, but you need to break it down in very simple terms and like, you know, Karan mentioned earlier, you know, put yourself in an investor's shoes, look at, you know, the goals that, you know, talk in terms of what the investor would be thinking. I mean, talk on his lines, his or her lines, and possibly that might work fine. I think
taking off from Rajesh, say that, you know, the distributor has probably a role in this. Even because this is something that I've heard of. I am Viji Anand, formerly of SBI Mutual Fund. Now I'm an advisor. But this is about a person of another distributor who, in fact, says to the investor, if you are coming to me for 3 years or 5 years or 7 years, please don't come to me. He insists on 10-year SIP. And I believe he has 4,000 clients. Could there be some response from Mr. Harsh Viji for that?
No, I think that's a good strategy that's following. If you're able to replicate this across, you know, multiple advisors and obviously multiple clients, I think that's where the, you know, message would as such go through. Before we just conclude, we had put out a question, you know, on the app for a poll. The question was, do you think, you know, your investors are saving or your clients are saving enough, you know, for retirement? So let's you know, look at the answers. I think clearly about, you know, 68% says investors, you know, of you believe, the audience believes that their investors are not saving enough for retirement. So clearly, I think there is a gap. Lots of education possibly needs to go through in terms of, you know, building investor confidence and so on. I think that's the message that's come across through the discussion as well today. You know, with that, you know, we'll conclude the discussion and you know, thanks to each of you for coming here and sharing your views. Thank you.